Sandeep Tandon joins us. Let's take our conversation forward. Sandeep, it was looking bad, now it's looking ugly. Will it get worse and much worse before it gets better?
I tell you, even last week I said, we are at the cusp of that inflection point. Sometime it get extended for by a few days here and there. But we are all multiple data points. Let's dissect into different segments. Let's start with the dollar index first. Okay, we are already slightly higher than 104. I think the worst case scenario we are approaching towards 105, which can happen in next one, two, or maybe few trading sessions. So if you ask me, dollar index breaking 105 can be very disaster. Answer is yes. But given the data points which we are looking at, it is showing us some signs that it should peak out. And so is the case. And this time the dollar index, if you really look at when this crisis started, the currency market was the most stable one, even including emerging market currency where Brazil and Real also actually appreciated. So the most stable thing has suddenly become weak. Okay, in last or maybe in this last 10, 12 trading session, particularly currencies market, whether it's emerging market or the developed market currencies against dollar has depreciated significantly. So it's another indication something which was the most stable one has deteriorated. So that is also giving me some signs that the stable thing which is now suddenly deteriorated is giving you some signs of bottoming characteristic, that the dollar index is peaking out and the global currencies are bottoming out. Let's look at one more data point in terms of Bitcoin, which is the representative of the risk appetite. From 48,000, it has corrected closer to 33 or 3,400 mark. Okay, now closer to 3,400, 34,000. I still believe that even Bitcoin is in the from a very near term perspective, giving us early signs of bottoming out, whether it's 30,000 or maybe 32,000. I think between 32,000, which is not very far away, and given the volatility which we see in the Bitcoin, because it reflects the the risk appetite for the masses, okay, or the particular new generation. That is also giving me a signs of that even Bitcoin should bottom out. And similarly, if I start looking at the dollar, if you look at the yield, okay, it's already crossed 3.1 or 1.2. I think closer to 3.35 or 3.36. I think dollar yield should also, I'm talking about 10-year US yield should also peak out. So if you combine multiple data points, NASDAQ closer to 12,000 mark, S&P closer to 4,000 mark. We are not talking about just from the levels point of view. I'm talking about the extreme scenario which is getting built in terms of our behavior data points. They are all showing extreme signs of pessimism. So one sharp up move is round the corner, whether it happened today, tomorrow type, or happen in the next 5 trading session. But we are in the closer to that inflection point where it should see a sharp reversal. So I will look for this opportunity to buy rather than getting panicked too much about it.
What you've told me so far is the global construct. Let's look at the India construct. This year we've done very well. S&P is down 14-15%. We are down not even in double digit. So does a dollar index or what is happening in NASDAQ, does it really matter to understand where India will move? Because so far till last week, we were handsomely outperforming. It's only because of RBI credit policy, which is a local event, we've started falling. So even what is happening in the world, I take your point, but is that relevant for India right now?
So if you really look at it, India has been outperforming the emerging market. India has been outperformed the global market. So, and which is also reflected in the, if you look at the USD INR pair also, which is relatively more stable when it compares to Asian currency, including China or some of the others name. So I think from India, relative strength is relatively more unique. We remain very constructive on India. So we are very cusp of that data points also for reverse. But given the global backdrop is equally important, the sharp up move which can come with the global background can be more meaningful, okay, rather than just looking Indian isolation. So even if I have to look at the risk appetite for global market, including India or the good liquidity, even that is slightly inching up. Okay, if I look at the much larger global liquidity data, okay, I think that is also on the verge of reversing. And maybe in week 10 days time, we will in the position to say with data point whether that has reversed or not. So multiple data points are reaching that inflection point where ideally it should reverse.
It's a new low for rupee, Sandeep, and typically when you have issues in the world, defensives they outperform, whether it is pharma or IT. This time in a difficult environment, despite a rupee tailwind, IT actually has underperformed. Pharma has been underperforming. Why is the classic defensive trade this time not working out?
So I think for that, we have to understand that I always say, like September 2021, we have seen multi-decade top for these growth stock in terms of valuation multiple. So given when we are talking about from a multi-decade top, which is already in place, okay, then obviously these sector or these stocks needs to correct. Okay, so every pullback rally will be used to exit because these are grossly overowned. Whole world has been hiding behind these names in last many years. So I think that trend has actually reversed. So I think I will not look at purely from the currency perspective just because of currency started depreciation to these sectors should benefit. Yes, pharma should because pharma is not that grossly overowned and but pharma has own challenges on the margins front. But that should bottom out maybe in a quarter or two. So we remain more constructive on pharma and IT definitely will be falling in the underperforming or market performer category, definitely not in the outperformance.
Good morning, Sandeep Nanta joining in. So just staying with that, now the street has been overweight on banks and financials, but even that trade has not materialized and it has underperformed. Can that change? Can that lead to whenever we come out of this cycle, the recovery?
So let me put this way, if you ask me, banking sector relative to IT will be outperformer. Answer is clearly yes, that banks will outperform the IT. Then it question comes within the banking, what should be the outperformer? So very clearly, PSU as a team should outperform the private sector. So given the background that we're talking about, the growth sector has peaked out in terms of valuation multiple. This is the value theme which will play out for a decade perspective. Then I would like to play value in that basket. So all PSU banks and their large private public sector banks which qualify, they're grossly underowned and currently quoting below the book or maybe closer to the book. Those are the names which one should capitalize.
Okay, so those are the names to capitalize with a special eye on the PSU bucket. Sandeep Tandon, what we've also seen, of course, is a sell-off of the FPIs, right? FPI ownership is now down to what, 15% versus the high of 22%. Can that be a trade if FPIs continue to press the sell button? They've done it in April as well. Is that an option to look at stocks that are not owned largely by FPIs?
So again, I will not look the FPI in isolation. I will again go back and remind you about it's about growth versus value because FPI were also grossly over-owned in the growth stock, and that trend has reversed globally. So it is not about FPI selling only in India. This is a sell-off which we are seeing in the growth stock globally. So we will also see the repercussion. But simultaneously, if you really look at the value names, okay, though we define value from a very different perspective, let's say industry define value, even those names will see opportunity. So if you, let's say down the line 2 quarters, when you sit down and analyze your data from the FI holding, you will see the growth stock has declined in terms of ownership and the value stock, their ownership will gradually increase. That's a trend we are seeing globally. So I will not look in isolation that FPIs are just seller. It's a selling in the growth stock, not in the value. So you have to rebalance your portfolio and optimize this opportunity.
Sandeep, hi there. Good morning. You had spoken earlier about pruning the portfolio as well from growth to value and how you had pruned down your exposure when it came to technology stocks. Right now as well, you said that there is an opportunity to look at buying in the markets as there is a fresh up move around the corner whenever that would be. So would you be looking at some of the, beaten down or neglected territories? Would you be sticking to some of the heavyweights, or what's going to be the strategy in terms of buying opportunity?
So I tell you the way we look at, obviously the more or less most of the stocks have corrected significantly. So there is a value or the opportunity in terms of neglected territory, both for the growth as well as value stock. Okay. So when we look at from our core holding perspective, so we dissect our portfolio in such a manner that we buy 70-80% core holding and 20-30% more from a trading perspective. So we will look for the 20-30% opportunity even in the technology names or the beaten down consumption names. So it's depending on the opportunity. But those are more of a tactical bets rather than the core positions.
What about the dollar index? Because you believe that one should really be dissecting this index, given the fact that it's moved quite sharply against some of the other emerging market currencies. Do you believe that there is some sort of a sharp move or any signs of bottoming out for the dollar index?
So in the beginning of the session, I started saying that we believe that dollar index should ideally peak out closer to 105 mark. We already crossed 104 levels currently. And if you really dissect the dollar index component, then you realize that both JPY and Euro, which are the large component, is also showing signs of bottoming out. There also we are seeing extreme pessimism. So if I have to look at the larger perspective, even the developed market, which is G6 currencies versus dollar, is also showing a size of reversal where emerging market currencies have actually started reversing. If you look at the Brazilian real, it's already appreciated for last 3 or 4 trading sessions. Even if you look at the South African ZAR also is started appreciating. So is the case with most of the commodities country, whether Australian dollar. A lot of commodities currencies is giving you early signs, okay, which is the first reflection that something is much better in the emerging market as compared to developed market. So we remain very constructive on the emerging market as a theme. This is, I think, theme which can play out for the current decade, and India should be a decisive winner in that theme.
Okay. Where does valuation come in? Let's understand that we are not in for an earnings upgrade cycle. I completely understand that there are problems in the world, but just for the benefit of our viewers, markets, they always climb the wall of worry. But for that to happen, Sandeep, either valuations have to become attractive or something has to change at a global level. So let's assume it is status quo. Nothing changes. The war lingers on, crude stays above 100, inflation remains strong. But then are valuations that attractive that they warrant a buy? Because in a slowing economy, if you're trading at a premium, then why should one buy stocks?
So Nikunj, same thing, we have to look at the global backdrop and dissect, which are the stocks quoting at premium. Even if you sit down and analyze, dissect the Nifty component or Nifty 50 or even Nifty 500 component or whichever indices, the frontline indices, then you realize that this expensive nature is coming because of the growth portfolio, not because of the value portfolio. So that data is also, Nifty is also technically a skewed structure, okay, where only outperformance are kept and underperformance are removed, okay. So you can't even compare that index from the global point of view. So it will remain in that outperformance from a longer term perspective. But if you really look at the slightly more, let's say, diversified Nifty 100 or Nifty 200 basket and then try to see growth versus value, then you will see that growth is still very skewed in terms of valuation. That's the reason overall these indices valuation from India point of view really looks very rich. But if you look for opportunity, which I'm talking about in the value, then they are not expensive. The entire emerging market, if you look at the dissect the growth versus value, then you see there's a deep value in the emerging market as well as some of the developed market also, because overall emerging market qualify as a value theme. And within that value theme, if you can just focus on the value stocks, because these are written down names, look at the energy sector, power sector, which is doing extremely well, the way the refinery margins is inching up, and we remain very constructive for the energy space. I think this is a space which can last for many years. It's not going to be just crisis which we are seeing. We have just seen a trailer of these power crises globally. We one have to be looked at, and there is a shortage on the nuclear front. People have not built capacity on the coal front. So these are the challenges which are real. And then I have to see, but you have to look at a relative opportunity. Both absolute matters and relative also matters. Okay. So on both an absolute and relative basis, we think there is a deep value in some of the names of the value theme which we are talking about. It's best to capitalize that opportunity and then prune down these expensive, so-called expensive and most admired category stocks. And which is the trend, not only India, it's the trend which we are seeing globally, and it is catching momentum.
Where will FMCG fit in now? They are not cheap, but they've gone through a time-wise correction.
So you're right, they have seen a good time-wise correction. So I think I will call them as a part of a tactical strategy. They can also give you a decent return from the current level, but keep in mind that FMCG companies have most of the FMCG company has the raw material challenges because I expect that agri prices will remain elevated for a decade. Okay. So with this background, whether Lever or Britannia or Nestle's of the world, where whole energy or whole agri, they are dependent on agri prices. So I think this is the inflation which we have seen. It is very, very early stages. Our view is that agri commodities were right from 2020 to till 2030 will can give you like 100 to 1000% returns. So that's the level of inflation which we are talking about in the agri commodities. So we remain very, very cautious in these names. Maybe from a tactical perspective, I can also participate, but these are not our core portfolio from a for the decade perspective.
Well, the street was expecting margin optimization in FY23. Now, certainly looking very difficult, isn't it? Let's see how this sector pans out. Sandeep Tandon, it's always a pleasure talking to you. Thank you so much for joining us live today to try and help us understand how to navigate this market, the kind of volatility that we're seeing, the kind of sell off that we're seeing as well.